Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 16th, 2017. It's about just after 11 o'clock Eastern Time, so the trading day is underway, and I wanted to do a quick video and really only look at the broad markets right now. Over the last week or so, I've been periodically touching on some of the things that stand out to me, both long and shorts. And this video, let's keep it simple. In fact, the reason wanted to do this video, I made a post in the trading room, and of course, I realize that doesn't give access. Silver members don't have access there, and then there's a lot of gold members that just don't have the time to frequent the trading room. So I made this post about half an hour ago. And I just wanted to share these thoughts, and this is the way I see the markets right now, and I'll just read this out quickly. I said it appears very likely the broad markets will experience a very sharp sell-off over the next week, and quite likely wiping out the previous gains over the last 2 to 3 weeks. And I know this market may seem bulletproof, but I've seen similar price action and technical setups in the past. And then I go on to say I'll post some of my favorite setups over the next couple days and into the weekend as far as individual shorts. You know, a lot of the bulk of the trades I've been putting out there lately, trade ideas, long and short, have been unofficial trade ideas. And that is just my confidence in this market. There are long setups. I've been trading probably as many, if not more, longs than shorts recently. But I'm also very much trying to avoid broad market, or I should say mainstream stocks that have a high correlation with the broad market. You know, the longs that I've had, Teva, Gilead, have a very low correlation with the broad market. And as always, I take setups, long or short, based on their individual chart patterns, irrespective of what the broad market's doing, especially when you're trading things like commodity. You know, we had wheat, for example, hit our first swing target, the final swing target today. Still looks good for a longer term trade. There's still some commodities I like, but not to digress too much, let me just get back to the point here that I was trying to make. Is I shared one strategy. Now I have never and don't ever plan to put options as official trade ideas on the site. Number one, I know a lot of traders out there or individual investors don't have either the ability to trade options, you have to have an options agreement, and or the experience. There's a lot to options, especially the more complex strategy. Most professional options traders don't just go out and buy a put or a call. They use hedged paired trades to limit their loss potential. And but a simple, straightforward strategy, and I shared it here in the trading room today, is to if you think there's a very high probability of a pretty swift correction and very little upside in the market, then at times like this, with the VIX being low, I mentioned here the VIX is near the bottom of its historical trading range. There seems to be no fear in this market right now. That's measured by sentiment indicators and other things, and I'll get to in a minute. And I often talk about and have very often in the past highlighted a phenomenon that I refer to as the OPEX ramp, which is the tendency of the market to rise leading into options expiration. Tomorrow, Friday, is the standard options expiration for the month of February, meaning your stock and index standard options expire tomorrow. And then there has been a fairly well pronounced, it's not 100%, nothing is 100% effective in the markets, but there is, I would say, and again, I've gone over the charts, there's some filters I use in there, but more often than not, you get that ramp into OPEX, and then following within either immediately, meaning the day after, the Monday after, or within that first week, the market tends to top out and corrects and fades or gives back a lot of the gains that they ramp the market into OPEX. And as I said on those charts in the past, if you've already had a sharp correction the previous month or leading right up into that OPEX ramp, then you may not get the fade. But we haven't had a correction. We are long overdue. And again, I see, based on my experience, seeing similar parts, similar technical developments, sentiment, and a dozen other factors that go into the market. I've seen this before, and I think this strategy might work. So what I was saying here is, I use an example. If you were to take a trade in XYZ, a fictional company, and you like to trade, I'll just use round numbers, $10,000 position size, you have a 15% profit target, and a 5% stop loss. That's a 3-to-1 risk return ratio. So if you're stopped out, you lose $500 and you move on. So my logic here is, and I don't do this very often, but when I see an above average risk of a sharp correction like I do now, you can take that same amount, and again, it's all relative to your position size that you're willing to lose if stopped out of a trade. So in this case, if you were willing to take a $500 loss on if stopped out on a trade of $10,000, you could take $500 and put it into puts. Right now, I think the most meat on the bone would be in IWM and or QQQ. So I've been sprinkling cash into both of those over the last couple days here. And as I mentioned, I also have a short position on TF, which are the Russell 2000 E-mini futures. And I will share, I still think the semis are on the verge of a correction. Some of the casino stocks are starting to play out today. MGM was down sharply earlier. I had a price alert on that. So there are some individual setups out there, most certainly. All right, let's get to the charts. Just wanted to share my thoughts there. Before we go into the charts of the broad market, let's just take a look at, this is a chart that I've shared many times in the past. This is the CPC, which is the total put-to-call ratio, and it just measures this top chart up here. The top part of the chart shows you the total put-to-call ratio, and when it reaches that lower end of the range, I have a line here that I set. It looks to be about 62 or so, that blue line. And again, I've shared this chart in the past. Let me move it up a little bit so you can see everything down here. When we've hit that level, you can see the dotted line. Sometimes the effect is immediate. Back here, right after the market topped in 07, we had a 56% drop from that point. At this point, and when I box these in, this is what I refer to as a cluster. When you have these readings in relative close proximity, a relative can be a span of months, which it was in that case back here. It was maybe a month or so there. Maybe 2 months here, and about 3 months or so right here most recently. So this span was very close to this one, very similar. We had an 18% drop. So what these arrows show down here is when each of those tags on or below that blue line happened, meaning, again, that is an extreme drop in the put-to-call ratio. And the reason I like this indicator so much is a lot of people look at the AAII, the American Association of Individual Investors sentiment, and I do too. But that is, the CPC is where people are putting their money where their mouth is. It's one thing to be bearish or bullish in rhetoric, which is what a sentiment survey like AAII is. They poll individual investors and ask them their outlook on the market. Are they bullish, bearish, or neutral? And you might say you're bullish, but you are not fully committed to the market. Maybe you are, maybe you aren't. However, this is, again, a indicator, like I like to say, people putting their money where their mouth is. So when you see this extreme complacency, this represents a lot more call buying than put buying when you have these extremes, meaning everybody's bullish. And when everybody's bullish, that means you're pretty much committed to the markets at that point. You don't have many bears. You don't have a lot of shorts. And as you can see here, there's the history of these corrections without fail. We haven't had, again, I clustered a few of these together. The black arrow shows that sometimes it takes a couple months before that reading hits for the correction to play out, but we had a 21% drop in the S&P, which also raises a question. I've seen so many stats that this is the second longest bull market in history, and they count from the 2009 lows. Well, the S&P 500 dropped over 21%. So did the NASDAQ composite. So technically, you did have a bear market there at that point, and that's the conventional measure of a bear market, 20% drop. But again, neither here nor there. It's the market has been very strong since 2009, no doubt about that. But there have been some very profitable to trade on the short side corrections along the way, 10% drop, 16% drop, and again, without fail, when at least spanning going back, looks like over a decade here, once you have these clusters of readings, yes, there may be a lag time from the first and even second reading, even the third reading, and that's the case so far. We had that third reading, and I did highlight that towards the end of the year, and here we are, and the market has yet to drop. And if it doesn't, if it continues to power on up for, let's say, another 3 or 4 or 5 months without a drop of 10% or more, it is possible, but that will be the first time we've seen that in a long time. So again, this speaks volumes to me, and it tells me to be on the lookout for not just a pullback, not a regular 2, 3, 4% buy the dip pullback, but a drop of 10% or more as we've had in the past. Now, if you don't want to jump the gun, because I know I've personally jumped the gun on some shorts, over the last few months, and I know others have. So these are the levels I'm watching. I've gone over this quite a bit recently in videos. Here's the cues. We had this wedge, a breakdown, a long back test underneath. But again, I mentioned watching this uptrend line right now, this what I call a minor uptrend line. We're still making a divergent high. So despite the fact this market seems bulletproof and continues higher, the charts remain clearly showing us that is a divergent high, which warns of an impending, very likely trend change. Now, if we zoom down to the 15-minute time frame, which I did here, here's a trend line that I have. This is really a pretty important one. I'll color that. Let's just make it yellow so it stands out. So we had a minor uptrend line. I actually did this chart this morning before it broke down. We've broken down, and look, pretty impulsive so far. So we broke this minor uptrend line, fairly well defined. That's the first support level. This will be our next support level here. You can replicate this on your own charts. You can see the points that I'm connecting. And then I think this will be let's just say the nail in the coffin level. If it's 127.75, if that level goes, there's a gap back there and a couple reactions. And I think that will have certainly put our trend indicators down here, more than likely roll these over to bearish, and like I said, I think instead of just a controlled soft pullback, I'm looking for a pretty sharp one. So right now we've wedged a little higher. This is the 60-minute chart of the SPY. Here's that trend line that I've had. I need to revise this one. So really this looks like a price channel at this point now. Here's the divergent high. Let's color it yellow. So you take that line with this line. So here's a price channel that the SPY is working its way up within. And bigger picture would be a break of the bottom of this channel. Right now, is that going to happen? Hard to say. Let's just see how the charts look when we get there. But this is the trend line that I'm watching, this minor uptrend line. I pointed that out recently. And looks like we're testing it right now, maybe moving slightly below it. Here we zoom in on the 15-minute chart. We can see it a little bit better. There's a breakdown if I do it that way. Now if I want to come in and capture the bottom, that little candlestick tail there, we can do that. I'll have to tighten this line up a bit. So we're right on it. That's how I had it drawn on the 60-minute chart. So we'll give the SPY the benefit of the doubt. Let's watch this trend line. And then the nail in the coffin level, similar to the cues, there's that same gap from back around. It looks to be about February 10th or 11th. And that level is at, we'll call it 232 even. Let's just say that. I have 232.04 there. So those are levels to watch. And price targets, well, that's, again, go back to the 60-minute chart. And you can see, since I've started adding these price targets down here, we've walked quite a bit higher. So I can just tell you right now, let me just give you the targets in green, near-term pullback targets, especially if you want the most bang for your buck on options, you play the near month. Now, obviously, you don't buy tomorrow's expiration. You want to go out at least to next month. That would be the March, I think they are March 17th, third Friday of each month for the standard expiration. Or you can give yourself an extra month and go out to April. What happens if we do have a sharp correction next week? The near month contracts are going to move a lot more than the April contracts, meaning the March contracts will rise in price. But it's a double-edged sword. If I'm correct on a sharp pullback, but it doesn't happen for another 4 weeks or so, then your March contracts expire worthless, and the April ones could pay off. So that's always the rub with options, is you not only have to get your directional call right, you have to get the timing right. Unlike a stock where if you go long or short, as long as you're not stopped out. If that thing trades sideways for a while and finally takes off and goes in the direction you wanted, it could take months or even years, and you don't lose money. You make money. But unlike stocks on options, you have to have both the directional call and the timing right. Pays off in spades if you do that, and also you tend to lose most or all of your money, especially if they do expire worthless if you don't get it right. So there it is. All the divergences, everything I've pointed out. I'm not going to beat a dead horse. Just another divergent high, trend lines to watch, and some near-term targets if you want to trade the SPY. ES, whatever you want. 232 would be your first pullback target. 229.70-ish. Again, these aren't adjusted for an optimal fill. These are just the actual support levels. And then the bottom of this channel. And I do think, my guess is, at the very least, based on the scope of these divergences, I expect to move down to this channel. And I'll just say it. I expect a break of that trend line. We might have a reaction the first time we get there. That also may come in around this 229.71 level. If and when this line gets there, I wouldn't be surprised. So to draw it out, something like this. Maybe a little reaction or blip right there, most likely, and then a move down to come in at this intersecting horizontal and uptrend line support. And again, based on the scope and length of these divergences, after a reaction, I think that trend line goes. But we'll see. We'll just have to get there. And if you're only looking, again, to play a near month or, the April put options or any other type of short-term pullback trade, if you're not an options trader or don't know what you're doing, please stay away from options. You have, many ways to short the market via leverage or non-leveraged ETFs. There's a ton of them out there. Pick your favorite. Especially on a short-term trade and on index tracking ETFs, there's not a lot of decay, so I have no problem using QID or even SQQQ, which is the 3 times short on the Qs for a quick pullback trade, or if you're trading the small caps, TZAs, the 3 times leverage. And it's really mood. If you use 3 times leverage, you should have a 1/3 position size versus just shorting IWM or QQQ. So factor that all in, guys. Don't ever think because it's leverage just by one instrument you can put the same amount in that you would normally if you're trading the index itself. You always have to account for the leverage. So that's that, and we'll wrap it up here. Keep this one relatively brief. And if you guys have any questions, I'll be around in the trading room. Just shoot me a inquiry if you want a chart opinion or anything else. This has been Randy Finney with the Right Side of the Chart. Hope you enjoyed it.